Hi and welcome to Swissquote's Daily Market Talk. It is Wednesday, September 25th. The Chinese stimulus measures and the rising dovish central bank bets will continue to fuel global equity markets as gold renews record on the back of tense geopolitical setup in the Middle East and also the weakening US dollar. So let's continue to count, guys. 41. The S&P 500 celebrated its 41st record high yesterday, even though yesterday's trading session began on a softish note after the latest data showed the biggest drop in the US consumer sentiment since August 2021. Another report revealing that, Jensen Huang, Nvidia CEO, is done selling his Nvidia shares, outshine the doom and gloom of the consumer sentiment report, and sent Nvidia 4% higher yesterday and the S&P 500 to 5735 level. The Nasdaq 100 added on its gains as well. The Dow Jones traded at an all-time high level, and that even though Visa tumbled 5.5% after being sued by the DOJ for illegally monopolizing the debit card market, and the small caps in the US eked out small gains as well. So voila, your investor sentiment is far better than your average consumers that's in the street. And the fact that consumer sentiment is not so great also contributes to inflating the dovish Fed expectations and improving the market mood because, the typical bad news is good news is in play right now. So swap market is now priced in a bit more than 75 basis point cut from the Fed for the remainder of this year. And I think it's too much, obviously, but Mr. Jerome Powell and company probably think that it is probably doable if the market demands it, and activity on Fed funds futures also assesses more probability to another 50 basis point cut in the Fed's November meeting than a 25 basis point cut. And of course, there's China that also keeps on revealing measures to boost growth since Monday this week. So they first cut their repo, their reserve, and their existing mortgage rates, remember, earlier this week. And today, they announced a 30 basis point cut to their MLF rate, which is the one-year policy rate. So the latter further fueled the Chinese equity rally. The CSI 300 index, which rallied more than 4% at yesterday's trading session, added another 2%. This morning, the index is now testing its 100 and 200-day moving averages to the upside. Then the Hang Seng index in Hong Kong recorded about the same rally than the CSI 300 and is now testing its May highs. And wait, because Nasdaq's Golden Dragon China index jumped 9% yesterday in the US. Alibaba advanced nearly 8% and looks like it could actually test $100 per share psychological resistance for the very first time in more than a year, while PDD jumped 11% yesterday on hope that the latest stimulus measures from China will bring investors back to Chinese equities. Now, all this is great news, but the problem is, these stimulus measures will take time to show in the economic data, and the latter could demoralize investors if the economic data remains soft for a while, which I think could be the case. And the measures won't do much to fix the country's deepest and long-term worries, mind you, like they won't reverse the Chinese local government's heavy debt burden, for example, or they won't reverse Chinese aging population, and they will hardly boost the demand-led growth in China until everybody there feels that the worst is behind them. So long-term investors appreciate the efforts, yes, but they prefer to watch from a distance for now. But this being said, the Chinese stimulus measures actually help improve mood among global mining companies and their investors. BHP, for example, jumped 3% yesterday in Australia and another 3% at today's trading session. Then Rio Tinto and Glencore jumped 4% yesterday, and they will probably continue their journey to the north today as well. And commodity-friendly Aussie remains bid today, a bit retained probably by the fact that inflation in Australia hit a 3-year low, but the Aussie Bulls now set their eyes on the 70 cents level against the US dollar as their next natural target, and the prospects for the FTSE 100 are improving. And other than miners, the Chinese stimulus measures could also boost the European stocks that have a good China exposure. Now, I'm obviously thinking of LVMH or watches of Switzerland, for example, which have been, heavily hit over the past year, and so due to this, uncheerable Chinese economy. But zooming out, the European economies continue to worry, to say the least, because released yesterday, Germany's business outlook deteriorated further in September, and the latter reinforced fears of possible recession in the country. And that, combined to soft PMI figures released just earlier this week, will boost the probability of another European Central Bank cut in October meeting. Now, I believe that if we see no surprise in the upcoming inflation updates from the European countries, there will be actually a strong case for a 25 base point cut from the ECB next month. Now, I know that as RBA's Michel Bullock, ECB's Christine Lagarde is also willing to mind her own business and don't be influenced by what the Fed does. But in reality, the fact that the Fed turns this dovish should actually help softening the hand of the other central bankers as well. If nothing, the softening US dollar across the board does have an additional easing effect on global inflation numbers because simply energy and commodities, for example, are traded in terms of US dollars on the international markets. And that alone is a good and a strong reason to believe that we will have some more dovish rate outlook for everyone who is not the Fed as well. I mean, look, the euro dollar is testing the 112 resistance to the upside again this morning. But the economic data from the Eurozone released since the beginning of this week, points at one direction, and that's weakening European economy. So it is actually not hard to guess that the US dollar's own weakness has more to do with the euro dollar's gains this week than the European countries' own fundamentals themselves. And indeed, the US dollar remains broadly under a decent selling pressure. The US dollar index continues to push toward this year's lows, and the latter continues to support gold's golden rally as well, because the price of an ounce runs from record to record in the overbought market territory with the rising geopolitical tensions between Israel and Lebanon, giving obviously an additional hand from those who prefer to fly to safety as tensions there mount quite uncontrollably. And in this context, crude oil is also better bid this week. The rising geopolitical tensions of the Middle East and, of course, the Chinese stimulus measures strengthen the oil bulls' hands, but the $72.85 per barrel level, which is the major Fibonacci level, is yet to be clear to send the price of a barrel into the medium-term bullish consolidation zone. Now, for now, the soft global demand prospects and ample supply keep the top side limited in oil. Oil producers and IEA actually thinks that the green transition around the world and political efforts to reduce the carbon emissions will have a material impact on global oil demand in the next decades. A view actually that OPEC doesn't share at all. They, on the contrary, think that global oil demand will actually increase by 11 million barrels by 2030 and by 18 million barrels, so by around 18% by 2050, as the need for energy security should slow down the green transition and keep demand for fossil fuel quite strong, at least stronger than ideal. Because they say that India alone will be consuming 8 million barrels per day more by 2050. So voila. This is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.